Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And this episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing ETF shop, democratizing access to the most sophisticated alternative strategies. With diversifying strategies like market-neutral, equity long, short, managed futures, and multi-strat quant, Simplify has a suite of compelling tools to help address the biggest concerns with the classic 60-40 portfolio. Check out their website at simplify.us. That's simplify.us, and you can find their entire lineup of ETFs at simplify.us/ETFs. Now, we are about 1 week out from CPI Day, and so that's what you have to look forward to next week. But I want to talk briefly about two items that may or may not bear on the path of inflation going forward and our confidence in that path. So first, we're going to talk about personnel issues. There have been a couple of interesting stories involving inflation and involving CPI and involving the Bureau of Labor Statistics and involving personnel, and I want to address both of them. The first one is, and the easy one to address, I guess, is the firing last week of Erica McIntarfer, who was the head of the Bureau of Labor Statistics. She was fired by President Trump, and that provoked the usual outrage and the usual complaints from the usual quarters, the folks who complain about anything that Trump does. Those complaints were predictable. But there were also some complaints from economists and who said that such a move as firing the head of the BLS could diminish the credibility of the Bureau of Labor Statistics and of the government data produced by the Bureau of Labor Statistics, of which CPI is a very important one of those things. Speaking of diminished credibility, if you complain about everything that the guy you don't like does, then your credibility when you complain goes down pretty quickly. It really is okay to say that, some ideas are good, some ideas are bad, and some just don't matter, without just assuming that, if what you say is that this person I don't like, every single thing that they do, no matter what, is just terrible and evil and whatever. First of all, you aren't describing a political opponent, you're describing evil versus good. But secondly, you're going to get yourself backed into very strange corners where the person you hate takes actually a pretty smart position, and because you reflexively disagree with anything that they say, you have to take a really stupid position. And I would argue that some of that has been happening. But the bottom line is, don't just reflexively complain about anything, actually try to think it through. And that's what we tried to do on Sense and Sensibility. This particular problem falls in the category of it doesn't really matter. But let me give you some data here. Since 1990, a bit more than 35 years, the Bureau of Labor Statistics has been headed by an appointed commissioner about 3/4 of the time, and by an interim commissioner about 1/4 of the time. So literally about 1 year out of every 4, there isn't an appointed commissioner. It's somebody who's just filling in. So that tells you how important the official commissioner must be, right? Because if it was really super important, like you wouldn't see that from the Department of Defense, right? You're not going to see the Secretary of Defense, 1 year out of every 4. He's just, somebody who's holding the seat warm. So that tells you a little bit of how important it is. Catherine Abraham left the office in October 2001, and it was 9 months later when her quote-unquote permanent replacement, Kathleen Utgoff, took over. Kathleen Utgoff left in July 2006, and it was a year and a half before Keith Hall assumed the title. And then there was another year after Keith left, and Erica Grosjean took over. And then 2 years after Erica Grosjean left, before William Beach came in, and almost a year between William Beach and the erstwhile Erica McIntarfer. So the message is pretty simple. The commissioner of the BLS doesn't really matter, and the commissioner is a political appointee. So this is not someone who works their way up to the top spot because of sheer quality and hard work. This is somebody who is appointed for one reason or another. And so if President Trump starts to fire the more or less permanent staff, the folks who do the calculations, then you might have a story, and I will have a completely different position when that happens. You'll have a reason to complain, and that will be fairly reasonable. If you're firing, the rank and file, who have calculated the CPI for 30 years, and you're going to get rid of them. Okay, now, now maybe you have something. But that's not what is happening here. Firing the head of the BLS is irrelevant. Now, it should be noted that the quality of the payrolls figures so not the CPI, but the quality of the payrolls figures has been really terrible recently, like almost unprecedentedly terrible. I have a hat tip here to Bill M. from Loch Elaine Capital. He pointed out that the 2-month downward revision of 258,000 jobs to May and June that we just saw, downward revision, 258,000, 250,000 jobs. That was the largest 2-month revision since 1968, other than during COVID. And COVID, we had a reason. So it isn't like the president had no argument about the quality of the numbers, right? And you could argue that he exercised restraint by firing the top person on the theory that the buck stops there. But most likely, it just doesn't matter, okay? But it's hard to argue that this person was doing her job so incredibly well that she should be completely immune, and that once she's been dismissed, the Bureau of Labor Statistics is now completely untrustworthy. The only reason that argument would have any traction is if you just don't like Donald Trump. And that's fine, but you should be, I think, objective and analytical about this. Now, the second personnel issue here is a little more complex, and it concerns the fact that due to cost cutting at the Bureau of Labor Statistics, a significantly larger proportion of the CPI sub-indices are being estimated now, and we won't give you the technical term, but basically being estimated instead of collected by price samplers. A larger proportion are being estimated than was normal, say 6 months and longer ago. So right now, upwards of 30% of series are now being estimated because there just aren't enough collectors, and because they got laid off because we're trying to trim government, okay, Doge stuff, but kind of beyond Doge, really. Again, let's cue the hysteria about how the Trump administration is making the numbers less dependable by firing really, really important people. Now you can probably insert here an evil laugh. So they can manipulate the numbers, and now they can do it because they fired Erica Galahad McIntyre. So that would be a conspiracy theorist, and we don't do those sorts of things. But so there's a lot of hysteria, or there has been some hysteria about, 30% of the CPI now is being estimated. Now, while it's true that the Bureau of Labor Statistics is now estimating more indices, the importance of that fact has been dramatically overstated. And again, I'm going to give you some numbers to show that. And while the good people at CNBC or CNN or Fox or anyone might not understand that, any competent economist should. And so that's why it's, again, especially disheartening when you see some economists, point this out and complain about it. Otherwise, very good economists. Because the BLS, and again, this is something that an economist should know. Maybe the anchor at CNBC doesn't know, okay? But the BLS doesn't just collect 20 prices or 20 series of prices. They collect hundreds of series on thousands of items in many different cities and regions, and each of those is a data series. And they're not all equally weighted. In the CPI report, the U.S. city average consists of roughly 200 lower-level indices. Those lower-level indices aggregate into slightly larger categories in several layers until you get up to the 8 major subcategories of housing, transportation, recreation, food and beverages, medical care, education, education and communication, apparel, and other. Those are the 8 major subgroups. But these 200 lower level indices are where we sample the prices, and that's what aggregates up. So if we had 30% of those estimated, that means 60 of those series are being estimated, which sounds awful. I mean, we're guessing at 30% of the index. We're going to be crazy off. But of course, that's not true. Those aren't equally sized indices. And if you're at the BLS and you're in charge, and I mean actually in charge, not like McIntyre, but you're actually in charge of producing the number, and you have fewer people to send out. Which categories are you going to have them focus on? You're just going to have them pick kind of a random 30% that they shouldn't collect? Or are you going to say, hey, you have limited time and limited manpower. Why don't you focus on getting those larger ones? Okay. Now keep in mind, by the way, that a lot of these categories aren't collected by data collectors anyway. Like, a lot of the apparel stuff comes from a point of sale database provided by a large retailer. And so we don't send out people with clipboards anymore for a lot of these things. But if you had to sort of focus on the top 70% of the most important things, you'd probably focus on the most important things, on the ones that have the highest weight. So the biggest of the lower level indices is a 25% chunk for owner's equivalent rent of primary residence. All right, which is why people complain about owner's equivalent rent of primary residence. It's a really important piece. It's 25%, but it also isn't something that we're going to ignore. It's not going to be in that 30%. The top 10% of all the categories add up to 66% of the weights of CPI. So 66% of the market basket is only 10% of the categories. So how much do the bottom 30% of the categories add up to? I should pause here and let you place your own guess. So we have these 200 categories. Take the bottom 60 and add up all the weights, okay? All the dollars spent. And divide that by the total dollars spent on the whole basket. What's that weight, do you think? The answer is 2.6%. So the bottom 60 categories add up to about 2.6% of the overall consumption basket. So if you simply ignored those 60 categories and you said that they were zero, okay, so that's worse than just ignoring it. That's actually being manifestly wrong by assuming zero. Then a monthly CPI print that would have been 0.3% would instead be 0.292%. So less than 1 basis point. If you intentionally missed them all and made them all zero. Okay. Now, maybe they're not choosing the bottom 30% of those categories to estimate. If you took the next 30% up, so like the 31st to the 60th percentile, then it weighs more. That adds up to 8.2% of the basket. So to reiterate, the bottom 60% of the CPI basket adds up to about 11% of consumption. All right. If that's where your 30% of the estimates are coming from, then I would submit to you that it's less than a catastrophe. And by the way, they are trying to estimate. They're not assuming that there's zero. They'll have errors because they're estimating. But if you assume that they're random errors and they offset, and we assume that the BLS isn't choosing the largest 30% of the categories, then it just doesn't matter much at all. In fact, you could make a pretty decent case for ignoring that data altogether, ignoring those bottom 60 categories, and it doesn't change the number hardly at all. If you add more error to those, then you have more error on 2.6% of the basket. It doesn't add very much error at all to the entire number. Again, you could make a pretty decent case to just ignore those numbers altogether. So personnel-wise, the story at BLS is the same as it is elsewhere. The government probably does have too many people in jobs that don't really need to be done, and we have to pay those people. So So maybe where we can trim government when there isn't any meaningful impact, given the massive multi-trillion-dollar debt we've accumulated, maybe we should consider trimming that government. Now, there's something to be having a complete data set. Okay, fine, I get it. But, if you had to go and figure out, who to trim, then trimming people who are doing stuff that has maybe a tiny impact but not a huge one, trimming and actually let's generalize this. If trimming the bottom 30% of the CPI loses only 2.6% of the weight, then what happens if we trim 30% of the federal workforce? You can get sort of something similar. Are you losing like 2.6% of the dynamics of the output of the government? I would argue that probably those are very similar dynamics. Okay, so anyway, those are my personnel topics, and I want to now move off into something a little bit different that I think is I like to think I think it's an interesting observation, and I wouldn't make it if I didn't think it was an interesting observation. So this is self-selection, and it's not necessarily timely. It's something that has been true for a while, but it occurred to me this week, and I figured, I'm going to point it out when I'm not having my mind, attacked by all the different CPI data coming out, and I'm talking about lots of other things. And this is a general observation that applies to the economy generally, and specifically about inflation, but also about sort of general growth dynamics. And it's an observation about how the economy has evolved since COVID, and a consequence that we've been seeing, but that's eventually going to fade away. So going back to COVID, as we all know, during COVID, goods production fell off a cliff because people weren't going in to produce goods. But demand for goods stayed about the same thanks to the stimulus. And we knew at the time, and we know now, that was obviously going to lead to inflation when you have just the same amount of money chasing vastly fewer goods. And yes, it did lead to inflation, and we got exactly what we thought was going to happen, and it wasn't transitory. We're still undergoing some of it. But what happened in COVID, of course, was that goods prices especially spiked, and goods sector employment went way down. But then when the goods sector rebounded, the services sector was in the process of slowing down a bit. And then after that, the goods sector suffered, production, manufacturing suffered again because of the bullwhip. They didn't produce during COVID, or they produced much less, and then business boomed when everybody had to go catch up to the demand, and then they overproduced and inventories got too high, and then orders fell. People were over ordering because the supply chain was all kind of screwed up. And then once all that started to heal, everyone found that, we have too much inventory, and so goods production fell off again. And so we had this, this oscillation, this artificial oscillation in the manufacturing side of the economy. But it was offset from the development of the services side of the economy. So this is why it's been very, very difficult for economists, and I kind of include myself in this, to go and forecast. We all kind of thought there would be a sort of this echo recession after the recovery from COVID, and it never happened, except that it did kind of happen. It isn't that we haven't had a recession. Rather, we've had goods recessions and services recessions that just seem to trade off to some degree, so that the overall economy, we've had we've had a couple of negative quarters, but we haven't really had a recession. The goods and services sectors have been out of sync ever since COVID put them out of sync. So, and I think that's just evident if you just sort of look at the numbers, and you look at the numbers coming out of the goods and services parts of the economy. But the effect of this, now here's what I want to talk about. The effect of this has been similar to what happens when the stock bond correlation is negative, right? So when you for many years before inflation went up, stocks and bonds had been inversely correlated from, the 90s onward, basically the last quarter century. And because of that, owning a portfolio of stocks and bonds was risk reducing, right? Because they moved in different directions, that the overall risk of the portfolio was lower, and it stabilized the overall portfolio. There's an inherent diversification in that stabilizes the whole thing. And of course, we know now that stock and bond correlations are positive because inflation is above the kind of low stable zone, and that means that stocks and bonds get correlated, as they always do, like they did in the 80s, and that makes all portfolios riskier than when stocks and bonds are negatively correlated. So let's apply this now to the economy. Point one, everyone, myself included, has been befuddled that we haven't seen a recession since COVID. We've seen the negative quarter or two here and there in terms of broad GDP growth, but the unemployment rate hasn't really done what it usually does when it gets 0.5% off the low, which is, usually when the unemployment rate goes up 0.5%, then it goes up a lot more. The so-called SOM rule that many of us followed for a couple of decades before SOM claimed it was her idea, but whatever, be that as it may. But the reason that we haven't had, I think, that normal dynamic in the unemployment rate and all the other sort of dynamics that, you get a signal that looks like we're headed to a recession, and then before you know it, we're in a recession. And we keep getting these signals, and then we don't get a recession. And that is, I think, because we're in this kind of rolling recession where different parts of the economy are in recession at different times, but never kind of most of it at the time. Now, that's better. This is an important point. This is better than a non-rolling recession because again, just like with stocks and bonds, it reduces the overall risk. The downside for the economy at any given time isn't that bad, even if it means the upside isn't as boomy. Point two, it also, from the inflation side of things, it also means that inflation, believe it or not, has been less volatile than it otherwise would have been. Now, stop. Okay, I know. Inflation's been very volatile. All right. But it's been less volatile than it would have been if goods and services had been correlated in the way that they normally are, goods and services prices. Core goods CPI year on year bottomed in June of 2020. Core services CPI didn't bottom until February of 2021. Then core goods peaked in February of 22. Core services didn't peak till Feb of 23. Core services now is still decelerating, but core goods bottomed again last August, a year ago. So that means that the overall level of inflation has been less volatile than it would be if goods and services inflation were highly correlated. So again, just to give you some data. So from June of 2020 to June of 2025, the correlation of year-on-year inflation rates for services, for core services and core goods was minus 0.07. Okay, so no correlation to slightly negative correlation of those inflation rates. From 1990 to 2020, for the prior 30 years, the correlation was 0.42, so demonstrably positively correlated. Goods and services inflation tended to move together. And it isn't right now. So this is good news. This is diversification, and it is just as good in an economic context as it is in an investing context. It's diversification for the economy. It means more stable growth and more stable inflation than we otherwise would have seen. We can see that in the growth that we haven't really had a recession. It's hard to believe it's true in inflation, but it really is. If you actually synchronize these series, I should do that one of these days. I should just synchronize the series and see what inflation would have been had services and goods peaked at the same time. It would have been higher. So it's less obvious because the overall level of inflation is so high relative to what it had been, and the overall volatility of inflation is so high relative to what it has been. But again, demonstrably, the volatility and the level of inflation would have been even higher, and I guess now the level would be even lower if those series had been synchronized. Now, that synchronization that COVID kicked off is not permanent, and that's, I guess, sort of the concluding point here. It's gone on for a while now, and it's going to go on for a while longer, but it's going that out of synchronization is going to get less and less over time. The oscillations are eventually going to dampen out, and the correlation is going to return. It's not tied to the overall volatility of inflation or the overall volatility of economic outcomes. It's due to the fact that the pendulums were perturbed at different times. I'm going to put a link in the show notes. Natural systems tend to synchronize. And the link in the show notes is going to show the fun pendulum synchronizing experiment. If you've never seen it, it's fun. You get metronomes and you intentionally put them all out of sync, but you put them on a table that is allowed to move. And what happens is, as if by magic, over a fairly short period of time, all the pendulums synchronize. And it's really fascinating to see. Economies work the same way, unless they're being continuously perturbed in different ways. Of course, they're always being perturbed in different ways. But when the perturbations are small relative to the overall amplitude of economic growth, then economies, and the global economy for that matter, will tend to synchronize rather than be decoupled. And so if that never happened, if they never synchronized, that would be actually a good thing for our economy. But it doesn't necessarily have to be a really terrible thing for the economy if the overall direction and volatility of inflation is lower. The problem is, I don't think the overall direction and volatility of inflation is going to continue to decline. And so therefore, we really would like to have the synchronization stay out of sync to keep that overall volatility lower. But as that gets resynced, then the overall volatility of inflation, whatever happens to the level, the overall volatility of inflation is going to go back up, and it's going to, I believe, continue to be more volatile going forward for the next decade or two than it was for the last decade or two. And that's all for today's podcast. Please like, subscribe, refer others to this podcast, send them to me. You can contact me at inflationguy@enduringinvestments.com, and the written blog is at inflationguy.blog. You can follow me on X at inflation_guy. If you have a question about inflation and you have an exposure, you should visit Enduring Investments, and most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.